The CEO of SEPLAT Petroleum Development Company says the company's half-year result further emphasizes the strong cash generation potential of their low-cost production base. Austin Avuru, CEO of SEPLAT, now joins me in studio for a breakdown of their earnings. Mr. Avuru, glad to have you on Power Lunch West Africa today.
Thank you.
Speak to me first on your general thoughts on the half-year results of your organization.
Half-year results were generally impressive. Just about in line with guidance. Our overall production for the first half of the year was just about 5% lower than guidance. And I'll explain the reasons a little later. We're going to play catch-up in the second half, and we'll end the year within guidance in terms of production. Prices has remained, oil price has remained generally around $60. Our gas prices, domestic gas prices, have also remained generally around $3 per 1,000 cubic feet of gas. So overall, earnings have been within guidance. We maintain fairly low-cost production, as we keep saying. Keep a firm grip on our operating costs and keep them as low as possible. And so overall, yes, our business has been cash generating. Our balance sheet is strong. So both our oil and gas businesses have been doing well.
So globally and even locally, when you look at it, it's been an interesting mix of interplay of dynamics for the oil sector. Speak to me on what the operating environment was like for you and how it, in fact, did impact your earnings.
You know, for us, operating environment will mean two things: oil prices and then stability of the Niger Delta, which will affect the overall production. Niger Delta in the first half was relatively stable. The evacuation pipelines recorded over 85% availability, which is within our budget guidance. Oil prices, as I said, have hovered around plus or minus around $60. And for us, oil prices within our budget range will almost be between $50 and $60. So above $50, we're quite comfortable. Above $60, we smile. And so overall, I would say the operating environment for the first half has been stable, both in terms of oil price and in terms of Niger Delta stability.
So I like that you hammered on oil prices. Help us understand clearly how the fluctuations in oil prices in recent times especially have impacted operators like yourself within the market.
So the way we run this, oil prices are out of our control. Costs are within our control. We work hard to keep our costs as low as possible. And then we budget within an oil price range, which enables us to predict what our top line and bottom line will be. And so when we budget within a range of $50 to $60, that as long as it doesn't fall below $50, we're comfortable. And when we hedge against the lower band of our oil price prediction. So we hedge against $50 per barrel. So even if it falls below $50, we're partly protected. That's the way we manage fluctuations in oil price in this business.
So what were the top drivers of your top line?
Top drivers would normally be production, and as I said, and price. And if production holds within your guidance and price holds within your guidance, then your earnings won't surprise you.
So given the understanding of what the half-year results have been and your response to it now, let's project forward now to the second half of the year, given the parameters and the realities on ground from the first half-year earnings that you have at the moment. Yes. What are your strategies going forward for the next half of the year?
So the second half of the year, we still have some catch-up to play on oil production.
You did highlight that.
Yes, because the first half of the year, now, business is picking up generally in the industry. Rig count is going up. Services are inching up in costs. There's slightly more difficulty in engaging rigs for your drilling. And so all of these contributed to something like a 3 to 4 month delay in some of the production that should have come out of our capex spend. Now that delay will play the catch up in the second half. So our second half production figure should be slightly higher than our first half. But the overall year-on-year production will be within guidance. That's our plan.
So talking about delays that you mentioned in some of your projects and catch-ups that you did, in fact, highlight a couple of times, I'd like you to give us an update on the Anoka development project. Oh,
that's the one we're excited about. That's on course. That's on course to be delivered about the end of the first half of 2021 to deliver 300 million square of gas, of lean gas, into the domestic market. And we will be producing and distributing locally LPG and exporting NGLs. So that's on course. As you know, we took FID in March at the level of SEPLAT, and the partnership is a 50-50 partnership between us and NNPC. That's the Anoka processing company. The company's board itself has also taken FID. So that's a project that is on course, and we're excited about it.
Are you at this point able to talk about, given your excitement, funding plans for the midstream unit of that project?
Yes, it's actually the entire project is a midstream project, and that's really where it is different. This is the first time a gas processing project outside of the LNG will be taken out of the upstream and run as a standalone midstream project between us and NNPC. So it's a real trial case for the entire industry, because that's the way the industry is going. Funding is in place. $300 million of equity funding has already been injected by the two partners, $150 million by SEPLAT and $150 million by NNPC. So you can see we programmed this project in such a way that there is sufficient uploading of the equity contribution so that the debt will come at the end of the project execution. And that's why we're confident that funding will not in any way delay the project.
So for you, the excitement about the project is not just internal. You can get feelers from the outside world that it is also a project that will indeed impact Nigeria's oil sector.
It will impact Nigeria's economy, because 300 million scoop of gas into the domestic market will generate something like 1.2 gigawatts of electricity. That's the way to put it in context. And we'll have local production of LPG that will displace all of the imported LPG. That over and above that, we're going ahead with NNPC as our partners to demonstrate that gas midstream projects can be developed on a commercial basis away from the upstream. It is key. That's the way the industry is moving.
I'm also interested in an update from you on the Anoka to Extravos pipeline. What's in the works regarding that?
Our interest in that pipeline is that our production will be the major throughput into that pipeline. Otherwise, the pipeline actually is owned by the Partnership and NPC joint venture. But we are supporting in finishing it. It's also on course to be finished by before Q4, between Q3 and Q4, somewhere in there. And we'll start the first year. As a matter of fact, hydro testing has been done successfully. So actually the pipeline is technically ready to receive crude. Just some final works are being done inside of the Chevron terminal, and then we'll start putting some our crude oil production into that pipeline.
So it's a mix of dynamics for you, as we highlighted earlier, both locally and externally, some within your control, some explicitly outside of your control. Speak to me of your outlook for the full year going forward.
The full year, as I said, we think will be within guidance. What we guide for production. And as I said, we take a window of our understanding of oil price, and that's how we do all of our budgeting and work program planning. So we think the full year will be within guidance. Strong cash flow generation, strong balance sheet that will prepare us for even a more exciting year in 2020.
Mr. Avuru, good luck to you, and many thanks to you for your time on Power Lunch West Africa.
Thank you.